Hi, everyone. This is Victor here again, and this is the second part of the first in a series of conversations we are having to discuss how to grow a business, saving on taxes, and how to invest in phenomenal companies. I have John Corcoran here of Rise 25, who has done literally thousands of interviews with successful entrepreneurs, investors, and CEOs. And we have flipped the script a bit, and he will be interviewing me today. So John.
Great. Thank you, Victor. Thank you for having me. Glad to be back. So yeah, as you said, we're going to be going through the second 10 of your 20 investing criteria, and I'm excited to dive into those. Of course, this episode is brought to you by Digital Porcupine. DigitalPorcupine.com is your home for understanding the digital transformation, how it's affecting companies and the greater economy, and how you can take advantage of this digital transformation. Digital Porcupine does this through analyzing, dissecting, and discussing 10 stocks, just 10 stocks for 10 great companies that are at the forefront of this digital transformation. And, you know, this digital transformation is happening whether you embrace it or not. The pandemic accelerated it by 5 years, but we're really at the beginning of an exponential curve that is happening right now. But the good news is you're not too late to the game. The gold rush has just started and everybody needs to pick picks and shovels. So how do you take advantage of this sea change happening all around us? We'll go to digitalporcupine.com and you can learn more and all about it. So, all right, let's dive into your 20 fundamental criteria for investing in high growth companies. We went through the first 10, and number 11 is competitive advantage. It could be new technology. It could be their leader. It could be having a moat around what they do or a niche or something like that. Take it away, Victor. What do you mean by that?
Competitive advantage is simply you don't want to be the third place company in a particular arena. I certainly wouldn't want to be starting a company right now that competed with Microsoft and Apple. You might have a massive opportunity there, but the reality is you're going to have incredible competition. So I tend to look for companies that are a leader in their industry. They're either a leader in their industry, they're the number one player, or they have some incredible moat that makes it incredibly difficult. They've built out infrastructure around the world for 10 years, and it would take another company. The barriers to entry are very, very high. Or they have some sort of niche where maybe they'll end up getting bought out because of that niche, but right now they're the experts in that niche and people go to them for that. Might be an example of that might be Slack. Slack was one of the first companies to come out. And what happened to them? They just got bought by, they got bought out. So, and so I either look for the absolute leader in whatever technology, or someone with a brand new technology that never existed before, who might have first mover advantage. Example of that might be, Snowflake, first to go public, first to get out there with the thing. Now they obviously have other competitors who are coming to the table and quickly closing the lead, but for a while there, Snowflake was in the lead.
Yeah. And some other ones that maybe, I'm a little slow, so you have to talk in small words for me, but so like Netflix, would that be an example? They were really kind of started the streaming wars, moved very early into streaming. Now a lot of other companies are copying them, and they have a pretty large subscriber base comparatively compared to some of their competitors out there. Would that be competitive advantage as well?
Yeah, absolutely. I mean, that's a perfect example, John. I don't own Netflix and never have, but it's dead on. Another example of that might be someone like DocuSign with their e-signature platform. Overnight success that started 21 years ago. They started in the year 2000 with their e-signature platform, and they've been building. Maybe it was 2001. They've been building that up over time, and then. And have by far the lead in that. And so now they're based on that platform, able to start adding other products, legal products and platforms to analyze contracts and so forth that kind of tie in with it. But they have a massive, first mover advantage. And that's why DocuSign has done so well, especially in the last couple of years with COVID-19 and the kind of push in the digital direction. They kind of pushed a lot of industries into what they needed, where they needed to be, like real estate, for instance.
I love that 21-year overnight success.
Exactly.
Let's talk about some of the other points that you make. So improving operating leverage, decreasing expenses to revenue ratio. Talk to us about that one.
Many of the second 10 of the criteria that I have, if you've watched the first segment, I talked about how companies that are growing super fast but not necessarily profitable. The second 10, I focus a little bit more on as you become an established company. At some point, any investor wants to see some profitability start to be present. You don't want them constantly losing money, and so. Some of the things that I look at in these second 10, include, moving toward profitability or achieving profitability and then accelerating quickly. And that can be, many different things. One is improving operating leverage. In order to have incredibly high revenues, you probably have to spend quite a bit of money on sales and marketing. And when you are a first mover advantage in a new technology, you're going to have people catching up to you. So it makes a lot of sense to spend $1.20 for every dollar you make. So you're spending more in sales and marketing or in sales and marketing and R&D to continue to grow your customer base and capture that customer base, because often there are 1, 2, 3 year recurring revenue deals, as we've discussed. But at some point, when you have those customers, your revenues have increased, call it 100 million or to 500 million. You want to see sales and marketing as a percentage of the revenue start to come down, and you want to see it flip from being negative profitability from a loss to profitability. And you see that in a lot of different ways. You want the improving operating leverage is you're decreasing basically your expenses to revenue ratio. And that can happen in R&D, sales and marketing, or G&A, which are sort of the three major buckets that you usually see. You want to see those numbers coming down relative to the revenue increasing significantly. And if your revenue is increasing 100% year over year, like a company like Snowflake, you would expect that to happen pretty quickly, unless you're also ramping up sales and marketing to keep that growth going for a while. So it's a balance for sure, but you want to see roughly improving operating leverage as a company starts to mature.
Okay, great. So next one, insider and institutional ownership. And you also say that founder-led is a huge plus in your book. Talk about that.
Yeah, we talked about that a little bit when I was talking about the management. It's the F in flesh. I like to see a founder-led company. That is, it's an indication of ownership. There's a lot more pride. There's been a bunch of studies done on founder-led companies versus non-founder-led companies, or where a CEO for hire comes in, and they're just not going to have the same amount on the line that the founder does. You're the founder of your company. I've been the founder of several companies. We're not going to let it fail, and we're going to do whatever it takes, however many sleepless nights it takes, and hire the right people. And there's no one else is going to go to sleep at night thinking and dreaming about how to make that company. So I do love to see founder-led companies, and insider and institutional ownership is a requirement. You want insider ownership because if you don't own stock in your company, John, why would I want to own stock in your company? I want you to believe that company, that company's stock is starting to go up. And perfect example of that is Dustin Moskovitz at Asana is he's buying his own stock hand over fist right now. And and every time the stock price drops, he's buying more and more and more. I love to see that. It shows me that he thinks that stock is going to go up, or that he thinks it's underappreciated. And then from an institutional ownership standpoint, a lot of companies can't be bought by large institutions. They can't be added. You don't just get added to the NASDAQ or a NASDAQ 100 or to the S&P 500. You sort of have to earn your way up there. And when you get to a certain size, a lot of large institutions are then allowed, by virtue of their own operating documents, to buy a company. So they can't just go buy any penny stock. And so as you get bigger and institutional investorship in your stock increases, they tend to hold longer, which gives stability. And when they buy, they're buying sometimes in massive, imagine BlackRock buying you. they're buying massive amounts of the shares. What happens? Supply and demand says if somebody's buying up all the shares, that stock is going to go through the roof. And I love to see that for stability. I love to see that because it shows confidence in that company because they're doing their own due diligence. And because I'm usually a year to 2 years ahead of them in getting into the company, it means that my company that I bought at whatever price is usually 5x by then.
Okay, good. All right. So, and then the next one is about there being some kind of consensus among, we'll call them different media companies. I think that maybe that's the accurate way of saying it. So you give like, I know you're a fan of Motley Fool,
Yes.
Seeking Alpha.
Yeah. So it's the question, you ask everyone, if you see a successful person, you want to know what's your source? Where do you find your companies? How do you analyze your companies? What are your news sources that you read on a daily basis? Because if you can figure out what their source is, you can pretty much figure out who they are. You probably can determine whether they're Republican or Democrat based on, do you listen to Fox News or do you listen to CNN? In that regard, we each search out, and if you're successful over time, you have certain people and sources that you're going to for information. And so I do follow Motley Fool. I don't subscribe, sorry, Motley Fool, to any of the newsletters or anything of that nature, but they have some great boards that I belong to where I'll sometimes write on those boards my thoughts on a particular company, analysis of a company, and I'll read the analysis of a lot of different people. And these are just people like me and you, John, that are, that have taken an interest in a particular company and throw it out there. And I don't take anything that they say verbatim, but they'll introduce me to a concept, and then I'll go to the actual source, which is usually the company's investor relations website, where I can actually open up the earnings release and read it. I can open up the text of the call that they had, and I can read it, and I can hear directly from the CEO what exactly happened. And so I want to make but what I've found is that when I'm reading, when I'm reading something on a board and then I'm hearing about it on Seeking Alpha, which is one news outlet that I occasionally read, and then I get a newsletter or two, and I encourage everyone to have a couple of newsletters, and I actually pay for a couple. One of them is this guy Bert who blogs. He's a little bit loquacious and long-winded, but he blogs and has some interesting insights on SaaS companies.
And what's his website?
I'd have to get back to you. I don't know.
We'll put it in the show notes.
But Investors Business Daily, you can follow certain websites that track institutional ownership. It all sort of starts to coalesce into a model that you then can use to determine, I use these 20 criteria we're talking about, but where do I get all that information? How do I hear the people? And I always encourage everybody, the first number one thing anyone should do investing is first go to the company's investors relations website and download last quarter's earnings call and read it. Or listen to it. You can go for a walk and listen to it. It's exactly 1 hour and has the analysts ask all the pertinent questions, and you can hear the answers to those questions. And then download the earnings release and the financials and spend some time looking at them and see, are they growing or are they not? Once you have that, and that is going directly to the source, everything else is opinion related, and there's going to be a lot of different opinions, but generally they tend to coalesce, and you'll find some amazing companies out of that. And so that's where I look for the consensus. I mean, I love when I read something in Seeking Alpha that says, sell this stock, it's the most horrible stock in the world. This is the reasons why. I look at those reasons why, and sometimes it's exactly the opposite. It's exactly the reason I want to be owning it, because I know they've already addressed it in a different way, and maybe the person who wrote the article, but it at least forces me to think. And I value that. I value the differences of opinion, and that's where investing comes in. You got to make your own decision.
So I want to ask you about the next one. And then after that, we're going to group a couple together because I think they might be similar, but so US based companies not investing in any Chinese companies. Now the China market has been growing at a tremendous rate over the last number of years. Are you missing out on an opportunity by limiting yourself in that way?
Maybe, and gladly so. I invested, it's been 15 years in a couple of different, I won't name them, stocks, that were Chinese based. And the problem, and I work for Pricewaterhouse and background in accounting and so forth, is that GAAP, GAAP, generally accepted accounting principles, is something that is required of all companies in the United States, and something that should be required of all companies listed on any exchange. And they're working toward that in our government right now, but it is absolutely not. And there's a lot of fraud and relationships between Chinese companies that are not disclosed, meaning you and your brother both have a company, you're selling stuff back and forth, and you're both recognizing revenue, but it's not actually getting sold to anyone outside, and you don't know that. That's just one example. You also have massive political concerns, and that example is right now present. Turn on CNN right now and you'll hear about the Chinese cracking down on all of their major companies. On CNBC just yesterday, a couple of pundits were saying, pull all of, I wouldn't be invested in any Chinese company. This has been a guideline of mine for about 15 years. It served me well because I took a bath on a couple of companies that I had invested in on the Chinese, and then found out that there were internal sales. There was accounting irregularities, and that's putting it very, very kindly, in my opinion, going on within the company, and they just weren't reporting what actually was and is. And so I just am very careful with, in particular, Chinese companies, but all companies, not just Chinese companies. And that's not to say there aren't Alibaba. There's some amazing companies over there that I have an immense amount of respect for, that they've built, sometimes just copies of what have been created here in the United States. And that's their prerogative, I guess. But I won't go into the politics of violation of patents and all the different things, but I just have to be super careful, because this is my portfolio and your money is your money, and you want to make sure that it's invested in a safe place. And in the same regard, outside of China, if I have a company that is all other things being equal, one company's in Israel and one company's in the United States, or here in Silicon Valley where I am, I'm going to invest in the one in Silicon Valley versus the one in Israel. Not to say anything about the Israelis. I actually have owned and love, some of the technology coming out of Israel right now. But it's foreign to the United States, and they may or may not be complying with all the GAAP regulations that I'm looking for in a company. And so when companies are exactly the same, I'll invest in the one that is in America versus the one outside of America, because I've just found that to be a more prudent approach, and because I've been stung a few times.
So we're a little short on time, but the last four or so, different guidelines that you have, the criteria have some similarities. So minimal or limited capital expenditure requirements and the ability to pivot quickly was one of them. Positive or rapidly improving cash flow from operations, profitability or the ability to get there quickly, little or no competition unless they are the clear sector leader, and increasing, hopefully rapidly, earnings, if not rapid revenue growth. Do you want to highlight any of those in particular?
As I mentioned before, anytime as a company matures, you expect it to move toward profitability. But while it is moving toward profitability, there's going to be infinite challenges. A company like WeWork, who had massive capital expenditures to build, all these buildings to have people in. Not only did they have that before COVID even came along, they were having challenges. And when COVID came along, they actually had zero revenues to pay for all those capital expenditures. And they had no way to pivot out of that. And that didn't end well for WeWork. So you want to make sure that I look for companies that have minimal or very little capital expenditures, which give them an ability to pivot into whatever situation that they have to pivot towards. I also look for companies that have tremendous or at least increasing cash flow from operations and free cash flow. Cash flow from operations is simply one of the three sections of the cash flow statement, and it's basically calculating how much cash is being generated by the operations after you adjust out the accruals and the depreciation, the other things that are non-cash related. And free cash flow is a measure of profitability, to understand how am I going to be able to pay for my pay my creditors? Am I going to be able to pay a dividend? Am I going to be able to continue to spend money on sales and marketing and R&D to improve my product that apply there? And so if you don't have the cash, you can go under. You can have your revenues can be through the roof, but if you haven't collected that cash and brought it in, and you have no cash to pay your credit and stuff, you can get into a big bind if you can't, unless you have obviously the ability to go back to the markets and ask for more money, which many of the companies these days do. So those are just a couple of examples. And of course, you eventually want a company that has positive earnings per share and is profitable. And most of these fast growth companies do not initially, but that's because they're making a conscious choice to invest it all back into sales and marketing and into R&D as they grow. But as those costs come down relative to the growth that they have, and they have these customers locked in for 3 years, it's almost like at any point they want, they can flip a switch and be profitable. They're just choosing not to be. And once they are, they're incredibly profitable, and they've captured a massive amount of the total available market at that point, hopefully, and they become a clear market leader.
Yeah. Well, this has been great. Victor, thank you for taking us through this. Where can people go? Digitalporcupine.com, I believe, is your digital home on the web. Where can people go to connect with you, learn more about you?
Yeah, absolutely. Digitalporcupine.com, I blog. I try to do that a couple of times a week. Feel free to sign up for the newsletter. It's free, and it's just my experience. I don't give advice. I don't tell people what to invest in, but I do share what the 10 companies that I invest in and my conviction in them and why. Yeah, so digitalporcupine.com, and you can feel free to leave me a note there if you'd like to. I'm also on Twitter, Nunnemaker.
Excellent. All right, Victor, thanks so much.
Thanks, John.